Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome. Good to be with you. My name is Joel Cundick. I am a financial advisor at actually based in Vienna, Virginia. Today, currently at Savant headquarters by happenstance. So the topic of today is avoiding a big tax surprise. And this is a topic near and dear to my heart. It's an interesting time to be doing the presentation, perhaps you might think, just because, well, weren't taxes due on April 15th? I know some of you have extended. It's still 2023 has not fully moved into the rearview mirror yet. But this is actually the time of year that I like to be talking about taxes. There are so many important things to consider when it's not the deadline, and that's what we're going to be covering today. Here's a little bit about the agenda. We're going to be going through something about the planning process for taxes. We'll talk about above the line strategies. These are strategies that reduce your income. We'll talk about below the line strategies. These are strategies that add your deduction to deductions from income. And then we'll cover some last topics that are relevant to this current financial year. Okay. So planning versus preparation. I introduced at the beginning that tax planning is a mindset, right? There is the act of preparing your return, which typically tends to be kind of chaotic. You're gathering your documents, the preparer is getting everything entered together with 1,000 other people, and then they are submitting the tax return. You're either going to get a refund or you're going to owe money. You get a refund, you're probably happy. You owe a lot of money or not. Whether you should be happy or not about that is beyond the scope of today's call. But suffice it to say that time frame is not the most productive for having a tax strategy conversation, right? I want you to be able to have a tax strategy conversation with your preparer, and I want you to know the kinds of questions to ask. So we're going to cover a lot of topics today. That's by intent. Tax is a broad area. I only have 45 minutes or so to be with you today. And as a result, but you're going to get a recording of this. You can look through again, listen a little bit more closely to some things I might have brought up. But what I'm really hoping you come away from this with is some notes about, hey, does this apply to me? That you can then have a better conversation either with your preparer, or if you self-prepare, you can go to do some additional research online, or feel free to schedule a 15-minute complimentary consultation with one of us here at Savant. This is what we do. This is what we love. Happy to have a tax conversation at any time, okay? So April 15th is the starting point for thinking about current year tax, really. And you should focus on next year's return while you are preparing this year's return, okay? What are the kinds of things that lead to big tax surprises? That's the topic for today, right? Avoiding a big tax surprise. I can say that every year tends to bring its differences. There are average years, right, where you've got a W-2, maybe 2 W-2s, maybe you've got some dividends from an investment accounts, but it's pretty similar to an average year tax-wise. Then there are surprise years. Things like, well, I sold a home this year, especially if I sold a rental property, or I'm getting an unusually large bonus. My business did extremely well last year. I'm at NVIDIA. And I need to talk about what to do with that. I'm changing jobs. So I've left a company and I'm joining a new company. Lots to consider there. That's always something to bring up to a tax preparer. And or high stock compensation. I work at NVIDIA, or I don't work at NVIDIA, and I have a lot of NVIDIA stock. Now what do I do with it, right? These are reasons to talk to your preparer. Why? Well, because those substantial one-time income events are the things that are going to lead to the surprises next April. And we don't have the tax software yet for next year, but we can do a pretty good job knowing what's coming. All right, from what we've seen and what we can kind of project, we already kind of know what the tax brackets are going to be next year. And so if you come to us and say, well, I've sold a lot of highly appreciated stock this year, how is that going to impact me on taxes? Not only can we get you a better idea of what you might owe next April, but we can also have a more of an intelligent conversation about, well, Is this a one-time spike year that we really should maybe move some deductions into or try and shift some income out of this year? Those are the kinds of conversations we want to have to manage that surprise event, to do what we can to minimize the tax impact. All right. So schedule the time with your tax preparer, probably August or November. October is not a great time. They tend to be doing actually a lot of extension returns at that time frame, but August, November tends to be a little bit more settled times. You can talk tax strategy. You also don't want to be doing it in December. The reason I say you don't want to do it in December is because a lot of the things that you need to do to adjust, it's too late to make large modifications. We'll be talking about a donor advised fund later today. Donor advised funds are pretty much impossible to create in December of a calendar year, just because that's when everybody else is thinking about doing them. We want to think a little bit farther in advance. When you go into that meeting, bring your year-to-date pay stub with you, bring any tax withholdings, talk about your unusual circumstances. I sold a rental property. I owned it for this many years. You know, this is what I'm thinking of doing with the proceeds. Have that conversation so you can think about, well, now how much should we withhold for taxes? And do we make estimated payments or not? In many cases, what your tax preparer is probably trying to do for you, this is what at least I've seen most tax preparers like to do. They're trying to safe harbor you. So they're trying to make sure you're making estimated payments throughout this year to get yourself to 110% of last year's tax liability. And if you do, from the tax preparer's perspective, then it's no problem, right? Well, okay, you'll owe $30,000 in April, but you would have owed it $30,000 now or $30,000 next April. There's no penalties. So why not keep the dollars in your pocket as long as possible? Most of the time when I talk to clients, their answer to that is, yeah, that's all good to know, but I would much rather known in April of the tax year that I was going to owe that amount the following April. I don't like being surprised in the following year. This is how you avoid that. And then the other thing you can do to avoid tax surprises is just make sure that you're having tax conversations with your financial advisor and that they're looking for a tax efficient approach to investing. We'll cover a couple of those today over the course of the call, but some advisors out there just kind of say, consult your tax preparer. We manage the investments, that's it. That what I like to hear when you're talking with an advisor is, yeah, let's talk about taxes. How can we mitigate those? We're happy to work with your preparer to, brainstorm strategies that might be effective for you. Okay. All right. We're going to talk about some above the line strategies now. An above the line strategy means that it's going to lower our income for the current year. All right. That can be a good thing because there are a number of states that peg their own tax regimes off of the federal AGI. So it can have something of a ripple effect throughout our return if we make alterations to above the line income. All right, how do we take advantage of that? First thing to think about is capital gains. Now, one of the things I think about with capital gains is this is something that actually can trigger penalties if I'm not careful, active throughout the middle of the tax year. You say, well, wait, I thought it could be safe harbored. Well, if you sold a ton of NVIDIA this month and you realized a lot of gains, even though you're safe harbored because it was a realized gain, you can trigger some penalties next year. Keep that in mind and be working with your advisor or preparer. So what are the thresholds at which we're worried about changes? If I can stay below $94,300 and I'm married filing jointly, I can get a 0% long-term capital gains rate. Now, that can be advantageous. It may not be. We can talk about other factors, but it is something to be aware of, right? Another inflection point is 20%. And for married filing jointly, the 20% tax rate on long-term capital gains starts at $580,000. Many of you on today's call, that's not going to be an issue for. Some of you on today's call, that is going to be an issue for. We want to be mindful of that toggle between 15 and 20%. If I can sell off holdings over a period of years and keep my income under that $580,000, so I'm never exposing to that extra 5% long-term capital gains rate, that can be advantageous. Always in keeping in mind, well, do I want to hold on to that security for that long? The most important thing is actually in the caveat down there at the bottom, and this will be relevant to a lot that we talk about tax. We don't want to let the tax tail wag the life dog, all right? We can look to save money on taxes. But let me give an example on that front. Let's say that I have, $500,000 of appreciation in a stock that I think has appreciated too much. I'm worried that it's going to drop significantly in value. And let's pin that drop in value as potentially 30%, right? If I decide to, okay, well, I'll only sell half this year and I'll sell half next year so I can avoid that extra 5% tax. And between now and next year, the stock drops 30%. Well, my tax saving strategy just ended up costing me life dollars, right? So we want to be aware, conscious of, is this tax strategy helping me? Does it stand the possibility to hurt me with what I think may happen to markets? It's a good example. All right. There's another tax, though, related to investment income. So it's not as simple as 0, 15, and 20. There's this other tier. It's called the net investment income tax. This was created in 2012 as part of the way of funding the Affordable Care Act. And there's an extra 3.8% tax applied to income above $250,000 if I'm married filing joint, $200,000 if I'm single. So these are thresholds to, again, be aware of. So that means I actually have a 0%, a 15%, an 18.8%, and a 23.8% capital gains tax. So again, do I want to avoid it or not? Part of it depends on other things going on in my life. You might ask then, well, how does the capital gains tax impact ordinary income? And the answer is, think of it like a pitcher. You're pouring water into a bowl. You pour the income in first, the ordinary income, wages, right? Then you pour the capital gains on top of that. So if I already had $200,000 of income, then after ordinary income, then after $50,000 of capital gains income, I'm going to trigger this 3.8% surtax. All right. But it's ordinary income first, capital gains are considered on top of that. All right. What does this apply to? Well, it applies to a lot. Taxable capital gains, dividends, passive income, interest, almost everything that we would think of investment, except for municipal bond interest. And that's because municipal bond interest is not taxable at the federal level. So there's also not a net investment income tax applied to it. Now, should you be using municipal bonds or not? We'll talk about that a little bit more, but it really depends on your personal tax situation. Then we have the question of, should I do a Roth IRA conversion? All right. So the benefit of doing a Roth IRA conversion in this year and 2025 potentially is that we've had the Tax Cuts and Jobs Act in place since 2018. Okay. It's going to expire December 31st of 2025. Absent any other tax change. Now, there's not going to be any tax changes this year. I think we can pretty much take that to the bank. Congress is incapable of passing anything right now. Is Congress going to be capable of passing a new tax bill at the beginning of 2025? I don't know. I would suspect it's going to be difficult, but let's just assume for now, the best thing you can do with taxes is say, well, here's what we know. We may make changes depending on what we learn. If what is currently in place for taxes holds true, then 2024 and 2025 could be very strong years to move income into. Say, well, okay, this is an above the line, but shift income into this year. Why would you do that? The reason you do that is you say, well, current tax rates are quite low relative to what they could be in 2026, or my current income is quite low because I retired from my job and I don't have required distributions yet for my IRA, and so my income's actually quite low. Zero tax is not necessarily a great place to be in unless you're going to be in zero tax bracket the rest of your life, which few of us are. If you're going to be subject to a much higher tax in a future year, what I'd rather do is blend taxes over multiple years. Roth IRA conversions allow us to do that. So what are we doing? We're taking money out of a traditional IRA. We're depositing it directly into a Roth IRA. So we're taking something that was going to be subject to income taxes on every dollar of gain into a vehicle that is going to be subject to no taxes on any dollar of gain, at least if current tax law holds true. This can be very powerful for us later in life, into our late 80s, early 90s. If we're taking money out and we've grown this money tax-free. It can be valuable to heirs. If they're inheriting funds in a Roth vehicle instead of a traditional IRA vehicle, they're going to owe a lot less taxes too. So we would want to look at post-retirement, pre-required distribution age. Do we do a lot of Roth IRA conversions then? And we may even, if let's say that you're in a much lower income status right now, you're working part-time for a period of time, you used to earn quite a bit more. We may still consider doing some Roth conversions in this year and next year, and maybe beyond. But it's an important thing to evaluate, right? We want to look at, hey, does this benefit me or not? So that's one of those cases where I'm saying, hey, more tax in the current year could actually help me from a lifetime tax perspective. Okay. I said I was going to talk about municipal bonds, so here we go. If I'm in a very high income tax rate, 32, 35, 37, typically the threshold at which I'm looking at this, it can be beneficial for me to put my bonds, my bond side of my portfolio into municipal bonds. The rationale there is that there is no federal tax on municipal bonds. There can be an avoidance of state tax as well, depending on which bonds are used. And the way you kind of think of this is, well, let's look at what the current rates of municipal bonds are and what the current rates of taxable bonds are, and then subtract tax from those. So if you're in a very low tax bracket, it's probably not going to help you because the municipal bonds are priced so that they're really only helping a certain set of people, right? If I was already subject to income, it's a zero income tax, and I buy a municipal bond instead of a taxable bond, well, the municipal bond pays a lower interest rate, right? The benefit to me is only if, yeah, pays a lower interest rate, but I was going to pay so much tax on the taxable bond that was going to take my total interest income lower after tax. It's another of those places. It's very easy to think of what's my total return. It's not as easy to think of what is my total after tax, after fee return. And that's the only number that really matters at the end of the day, but it's also a highly personal number. It's variable to every individual. The other thing you can do with your portfolio is make it tax efficient is look at an asset location strategy. I was already referring, we got three tax buckets here, right? We've got a taxable brokerage account that every dollar is going to be subject to long-term capital gains tax. We've got a traditional IRA or traditional 401k or whatever vehicle that is, that every dollar is going to be subject to ordinary income tax. And then we've got a Roth IRA that no dollars are going to be subject to tax. All growth is tax-free. So if I could put an aggressive investment in one of those three buckets, where would I put it? Ideally in the Roth. Of course, it's going to have the most volatility. So some years it's going to be lower than others. But over time, you would expect that vehicle to grow much faster than the rest of the portfolio. And you're putting it in a place where there's going to be lower tax dollars as a result, right? You'd like your best growth stuff to happen inside that Roth. You'd actually like to, if there's one vehicle that you would not want to grow as much, it's that traditional IRA that, you think, well, I want to grow that account, just like all my accounts. I've had many situations where someone's approached me and said, hey, why is my IRA not making as much money as everything else? Well, an advisor who's working according to an asset location strategy, that's by intent. The number one benefit of that traditional IRA vehicle is tax shifting, tax deferral, right? Move income out of a high tax year to a lower tax year. It is not beneficial from a growth perspective. Every dollar of gain is going to be subject to ordinary income tax. And I can't even avoid that at my death. There is no step up in basis on that vehicle, where there is a step up in basis on a taxable account, and you don't have to worry about taxes on a Roth IRA. So we may not want to grow the traditional IRA as much. If it's your only vehicle, then of course we're going to try and grow it, right? That you should be trying to grow it. But if we got multiple tax buckets, let's put the right assets in the right accounts. Let's not do the same strategy in all three accounts. We're not thinking about taxes properly that way. Maximizing your 401k. So what I typically say is I can't give you a 100% return investment anywhere guaranteed, right? That doesn't exist except in putting money into a 401k. I put the dollar into a 401k. I've got a match from my company, even if it's 50 cents on the dollar. Well, that's an automatic 50% return on my money. Right? So we want to make sure at least we are maximizing the match in our 401k, or we're walking away from money that the company would otherwise be willing to pay us. In 2024, you're allowed to put up to $23,000 into a 401k. That's the same number for a 403b. There's some other retirement plans out there with different thresholds, but that covers probably 90% of the people on this call. And for people 50 and over, you're allowed to put in an extra $7,500. And so that brings your total to $30,500. Now there's a little bit of a concern. There's going to be a change out there for anyone whose income is above $145,000. The IRS, the tax code is going to make it so that you can only put that catch up into a Roth vehicle. And that was supposed to happen this year, 2024. The problem, there's a lot of 401ks in this country that do not have a Roth vehicle. And so Congress said, all right, we're going to wait for 2 years on that. Now it's 2026 that's going to trigger. But as of 2026, if you want to use the catch up and you're 50 or over, you're going to have to put those funds into Roth. You're not going to be able to get a tax deferral on that. Okay. So, but for now, the point is put money into your 401k. It shifts income potentially out of this year if we're using the traditional option. And it's a powerful way, regardless of amplifying our contributions if we're getting some kind of match from the employer. Donating your IRA to charity. Once you're 70 and a half, and some of you think, wait, 70 and a half, I thought that's gone. I thought it's now 73. No, they're trying to keep financial advisors and CPAs employed, I guess, because they have not changed the date at which you can contribute to a charity using your IRA, using a qualified charitable distribution. That's still 70 and a half. Your required distribution age did move up. So once you're 70 and a half and not a day before, you have to wait until you're after 70 and a half. You are permitted to give up to $105,000 from your IRA directly to charity. So your advisor or your custodian could help with this. Call Charles Schwab. They would be able to, Fidelity, whoever your custodian, and say, I'm trying to do a qualified charitable distribution. Been there, done that. They all understand this. It's a very powerful vehicle. The idea is you give straight from your traditional IRA to charity. It's a tax-free transfer. So there's no other way of getting money out of that IRA that's not going to be subject to income taxes. This is. Now, the extra sauce, the sugar on top, is if you're 73 or over, this middle bullet, and you're subject to a required distribution, that QCD goes toward that required distribution. So if I had to take $50,000 out of my IRA this year, I'm 73 years old, and I give $10,000 to charity, I now only have to take $40,000 out of my traditional IRA. The other 10 that I gave to charity counts towards satisfying my 50. So it is an above the line deduction. It moves income downward. And typically when I'm working with people in their early 70s, they're no longer itemizing their deductions. And so their charitable giving otherwise is not really helping them from a tax perspective, right? This is another of those places, do I really want to do this if I wasn't already inclined? Probably not. But if I was already inclined to give charitably, then this QCD is something I should definitely explore once I'm 70 and a half. All right. Now let's go to some below the line strategies. What do we have here available to us? Okay. One of the simplest is to bunch itemized deductions to avoid our AGI limitations. So it used to be that the standard deduction was quite low and most people were itemizing. And now I think we're up to a point where almost 85% of the country is using the standard deduction. And if you're using the standard deduction, that means that your charitable gifts are not helping you on a tax perspective. And some of you might say, well, wait a second, I give that to my tax preparer every year. I'm sure that's helping me. Look at Schedule A of your tax return. If Schedule A of your tax return lists a bunch of stuff, makes a total, and then below it says, yeah, but the standard deduction is higher, then you don't even need to give all those charitable receipts or those medical receipts to your tax preparer because you're just taking the standard deduction. They don't necessarily circle back to you and specifically highlight that, right? But that's the case. Well, what could you do then to still take advantage of itemizing? One of the things you can do is you can bunch your deductions into a single tax year. So let's say I was going to give $10,000 charity this year, and I was going to give $10,000 to charity next year, and otherwise I'd be below that threshold for the standard deduction. If I give my 2024 gifts in January of 2025, so I'm not going to technically make any gift this year. I'm still going to get the standard deduction this year, but I move my $10,000 of gifts to January 2025, and then do my regular gifts in December of 2025. Well, now I've got $20,000 of charitable giving I just did in 2025, and that very well may push me to a point where I am now itemizing. Some of those charitable gifts are helping me in that tax year. Medical and dental expenses. Keep in mind, hey, medical and dental expenses only help you if they're greater than 7.5% of your adjusted gross income. And so there's a lot of years that's not going to happen. But if you get to a year where that looks like it's happening, that's a year you want to push a bunch of elective procedures into, right? You were thinking about getting braces some year, right? Okay, this is the year to do it. You had some kind of issue with your rotator cuff that you're like, oh, I should take care of that sometime. That's a tax year you want to put it into, because you are getting to the point where those medical expenses can actually help you to lower your income tax if you've bunched enough into the current year. All right. Okay. So what are some other ways we can use below the line deductions? Well, I can give, instead of with giving cash, I can give with appreciated securities. And now we'll come back to Nvidia and Broadcom, and these are the famous stocks making headlines right now. Or let's say you have a ton of appreciation in Bitcoin. I don't know. You can take an appreciated security and you can give it to charity instead of giving cash. Okay. When you do that, you're getting a double benefit. One is that you're getting the charitable deduction, right? That helps you. But two, you're avoiding a long-term capital gain that you were otherwise going to have to pay. So you could come to me and you could say, well, wait a second, I don't want to sell Nvidia. I love it. It's doing great. Let's leave it there. Okay, that's fine. But if you're going to give $10,000 to charity, why not use $10,000 of that stock and then just repurchase another $10,000 of Nvidia instead? You've now moved your cost basis up much higher, and you took a security that was extremely high appreciation, you gave it to a charity, and you avoided that long-term capital gain. All right. Very powerful way of giving. When I'm giving with appreciated securities, my limit is 30% of my AGI. I can give up to another 30% in cash to charity, so up to 60% overall, but I can only use the appreciated securities up to 30%. All right. Is there another way? Yeah, there's another way. So charitable giving got a lot of options. We can use the donor advised fund. So think of the donor advised fund like bunching your charitable deductions, but on a huge amount of steroids, right? Now, instead of bunching 2 years of charitable giving into a single year, maybe I'm bunching 10 or 20 years of charitable giving into a single year. Well, why would I want to do that? This is when you are in one of those big income years. You've sold a business. You've exercised a number of stock options that were highly appreciated. You got a huge bonus relative to other years. You're kind of saying, hey, I've got an income spike here. What do I do to manage this? Well, that's also going to be a year where a charitable deduction is probably going to help you more than any other tax year. So why not accelerate your charitable giving into that year? All right. How you do that? It's a donor advised fund. Think of a donor advised fund as like a parking lot for future charitable gifts. Schwab, Fidelity, American Endowment Foundation. There's a few places out there that run these donor advised funds. You are giving the money into the fund, which is technically a 501c3. So you get the tax deduction. However, once it's in the fund, then you have years over which to decide, who to grant the funds to from that. All right. And you can only give to 501c3s from that. So there's some nuance to when you can use it. But for most standard charitable giving you'd be doing, you can use the donor advised fund to make that gift. So you can contribute cash into it. But I'm a big fan of what other strategies could we already use from my previous slides. So I'd use the appreciated securities, right? So now I'm going to give my appreciated securities into the donor advised fund. So I get the double benefit. I get the charitable deduction and I avoid a long-term capital gain. And then I make grants from the donor advised fund over years to come. Now I do have a chart on this one, and this may help you visualize the bunching better as well. In this situation, I'm saying, all right, 5 years of charitable giving I was otherwise going to do. I'm going to accelerate it all into the current year. Option one is I just make direct gifts each year over 5 years. And you can see in this situation, just like most taxpayers, I'm not getting any benefit from that charitable giving because I'm taking the standard deduction. But what if instead I give 5 years worth of charitable donations, $196,000 into this donor advised fund in the current year? Well, guess what? I still get to take the standard deduction each of the following 4 years. So I haven't disadvantaged myself substantially in those years. but I've shifted income, I mean, deduction into this year where I already have an extensive amount of income. All right. There are situations, well, you could argue, well, wait, I was itemizing anyway, and I've just moved itemized deductions out of years 2 through 5 into this year. And again, my response would be, well, is this year going to be a higher tax year than you expect the next 4 years to be? Then you could really benefit yourself by doing this bunching into the current year. And sometimes, I mean, there are situations where if you're going to sell a concentrated business and you don't have an official agreement yet, you can reach out to some of these donor advised fund companies. You can give some of your business to the donor advised fund before selling it and avoid long-term capital gains on a section of the business. That's complex. So you want to be sure you're working with professionals, but that is something you should potentially consider if you expect to have a big sale of business this year or some future upcoming year. Okay. So those are our above the line and below the line strategies we consider. What is changing from a tax perspective? Well, Secure Act 2.0, which was signed into law on December 29th, 2022. It has some changes, and not all of them are current. They happen over several years. One of them I mentioned, right? And in 2026 right now, we're going to have that change to where catch-up contributions are going to have to be made into a Roth if I'm over a certain income threshold. But what happens in 2023? Well, last year, 2023 was the first year that the required minimum distribution age moved to 73 instead of 72. So it was 70 and a half a few years ago. They moved it to 72. It was so popular they decided to move it to 73. And in 2033, it's going to change to 75. So tax bill effects are not always instant. Like this is an example. We're going to get 2 years extra on the required distribution age about 9 years from now. Then you also got this benefit, which is nice. I mean, there was this huge penalty. If you missed a required distribution, you could owe a 50% tax penalty. And preparers tried to work with people to get those avoided if it was a one-time mistake. But what they've done right now is they've said, all right, it's 25%. It's not 50% anymore. They understood that, you know, this is a real problem because people end up in situations where under normal, you know, okay, somebody went to the hospital in November. We weren't able to make the required distribution by December 31st because of exigent circumstances. Should we really be assessed a 50% penalty? It's been reduced to 25%. There's going to be another 10%, another reduction to 10% if you fix it in a timely manner. So if you see it yourself, you fix it, you notify and say, hey, I fixed this. They will take the penalty down to 10%, right? Other changes to 2024. You now don't need to take required distributions from Roth 401ks. You already did not need to take them from Roth IRAs, but now, thank heavens, they've made it so you do not need to take pre-death required distributions from Roth 401ks. Now, there's many reasons you might not want to leave your money in that 401k. If I'm thinking of doing Roth conversions, I can't do Roth conversions inside of a 401k plan. But there's a lot of situations where maybe, hey, no, the 401k plan makes the most sense, but I don't want to have to take required distributions from it. And now you don't have to. Then we've got this great feature about 529 plans. So people have been saving into 529 plans for decades. They've been trying to make sure that they don't overfund the plan, because if you have excess funds left in the 529, what do you do with them? You can still use them for education for another family member. So, right, if you can put them in another child's name, a niece or nephew's name, you can move them into your own name if you want to do some advanced education. But now you've got this new option available that if the 529 has been open for 15 years, then you can do Roth contributions directly from the 529 up to $7,000 per year, right? So you could move up to $35,000 out of your 529, put it into a Roth IRA. So now my advice is shift where I'm saying, actually, hey, we may want to overfund the 529 by at least a little bit because we want to get the next generation started on the right note. When they finish school and they've got some money left over in the 529, we want to gift funds from the 529 straight into a Roth IRA for their benefit. All right. So there's an understanding that there's too much money left over in 529 plans. What can we do with this? Well, we keep the tax-free status by moving it out of the 529 into the Roth IRA, and then that tax-free status perpetuates. In 2025, this is an interesting one. you're going to get from ages 60 to 63. So not from 50 to 59 and not 64 or beyond, but 60 to 63. You get 4 years where you get a catch-up limit for moving from $7,000, $6,500, I think it is $6,500 this year, up to $10,000. And then that's going to increase each year. So there's this new kind of super catch-up option that you'll have available to you starting next year. And then we get to really kind of the extra credit section. And this is really if you have some very large income and you're not wanting to do the donor advised fund, but you want to give to charity and you want to do it in a kind of a as advantageous way to you as possible, but keep some control. You can use like a charitable remainder trust or charitable lead trust. So what are these? A remainder trust says that it's going to pay out funds to your heirs, non-charitable beneficiaries, over a period of time. And then at the end, if there's any money left over in it, which there should be if you set the percentages right, that amount remaining will go to charity. So that's going to get you some charitable deduction in this year. The one that's going to get you more of a charitable deduction is the charitable lead trust. This is flipped over, okay? Instead of giving to your heirs first, and if there's money left over, it goes to charity. This gives to the charity first, and if there's money left over, it goes to your heirs. This is going to get you a bigger charitable tax deduction, and it can be a very valuable tool, especially like a year where you sold a business. Unusually high income in the current year. And for purely from a practical perspective, this can be really nice. I mean, lots of people like to give to their university, right? Their alma mater. And what I've noticed is if you give, $25,000 to your alma mater, you just made a list, right? Good luck, because you're going to get calls every year from here on out. Hey, what are you going to give to me this year? Use the charitable lead trust. You say, no, don't worry about it. It's happening. It's happening over time. There's money going to you each year. Can you please not call me for 20 years, right? So that can be beneficial as well. So these are some advanced strategies. I'm not going to go into more detail in this setting, but you may want to ask your preparer. You may want to schedule a short call with us to chat about that, all right? Whether it applies to you. And lastly, business succession. This is a unique tax issue that we've got to really be thinking about carefully. You want to start thinking about the sale of your business years in advance of selling your business, because there's ways to set up buy-sell agreements where you do a predetermined price and terms for a future sale. There's ways of selling the business over multiple years that could help you from an income tax perspective, where it's some form of an earn-out where you don't recognize income for a period of years. There's risk associated with that as well. You want to value your business appropriately before you head into the transaction. Talk about like tax planning in advance. We want to be aware of this. What did I put in to fund the business? What is it worth now? I can run some calculations with that information about what the tax might stand to be if you were to sell the business. And then, as we said, there's all kinds of tax strategies you can use in a spike income year. All right. And we want to think about estate planning, right? What happens to that business if I pass away, if I'm an essential part of that business? What kind of value is lost, and how can we get around that with other strategies? All right. More to consider. Well, there's other things you might want to throw in there. You could use an employee stock ownership plan to get deductions over years in terms of your business. You want to factor in, doing some proper due diligence of your buyers. That kind of goes without saying. But there's things you can do for benefits for employees. Anyway, business succession itself is probably worthy of its own 5-hour course, right? But if you are thinking of doing that, my bottom line is saying, don't walk into it with just saying, hey, sold a business. Think about it well in advance and think about tax planning around it, because it is going to be probably the highest income tax year that you're going to have. All right. We covered a lot of ground there. I think we do have some time for some questions here. So let me look at the questions here. All right. See what we've got up. Okay. All right. Can one-time income events create the need for estimated taxes? Yeah, I mentioned just that briefly, but it's worth going into a bit more. If I sell appreciated securities in the middle of the tax year, and it's a lot of appreciated securities, I should look at making estimated payments. Okay, because I can put myself in a situation where, even though I'm safe harbored, that event of realizing a huge amount of capital gain, or I sold a business, for example, right, in that quarter, I need to look at making estimated payments, because the IRS is not going to just go ahead and say, oh, no, you were safe harbored, everything was normal. They're going to say, no, that was an abnormal tax year. You should have known that there was going to be tax due on that, and we're going to penalize you if you have not properly withheld via an estimated tax payment. Okay. What is likely to happen with the Tax Cuts and Jobs Act? Yeah. So I'm not a political expert. I live in the DC area. You think, to kind of rub off of me in the last 20 years. I think we're looking at right now, and this is worth taking a look. If you reach out and ask for for that consult, we can get you actually a table showing the comparison of the Tax Cuts and Jobs Act tax rates and the post sunsetting rates that would be in effect. It looks like it's going to sunset the end of 2025, unless we get a better a situation in Congress. Well, different people will have different opinions about what better is, but I'm saying unless there is enough support from one party to get a bill successfully passed through both houses, then you would say that not strong probability. And this is actually creating, beyond the scope of the call, but it's creating a lot of estate planning questions, because there's an estate tax threshold that's potentially going to cut in half that if we just allow everything to sunset. Okay. I wasn't thinking about giving a great deal to charity. This makes me want to rethink that. Should I? Great question. And the answer is really no. Unless you already have, this is true with most things with taxes these days, right? They've really simplified the tax code in a lot of ways to make it so that if you want to get a tax benefit, you have to give something up, right? And charitable giving is a classic example of that. If I want to save taxes by giving to charity, well, even if I'm in a 40% between state and federal rate, 40% tax rate, 60 cents of that gift is still coming from me, right? So this is not something that I'd want to give to charity so I can get that 40% deduction, because I've given up 60 cents on the dollar. If I already have charitable intent, then absolutely, there's all kinds of worlds of things we can do to add to that benefit. And hopefully we covered a number of them on today's call. But if you already didn't have charitable intent to begin with, that's one of those tax tail life dog things. I don't want to just make that gift because it cost me. It was a gift that in order to get it, it cost me a lot. All right. I think that is the time we have today for questions. So thank you for being with me today. I love talking about this stuff, and there's been some good, I can see that there's some questions we're going to need to get back to you on. If at any time you're looking for more help, please feel free to go to savantwealth.com and search around there, or reach out to us and schedule a complimentary consultation. We're always happy to do that. This is what we live, eat, and breathe: estate planning, taxes, insurance, retirement planning. This is all us. So thanks for your time. Have a wonderful day. Take care.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.